Good afternoon, everyone. Looks like we have a big group that is attending today, so we'll give them some time to sign in. Thanks for joining us today. Welcome to Miller Value Partners live year-end update for 2025. I'm David Yazdan, and I'm joined by my colleagues, portfolio managers Bill Miller IV and Dan Lysik. After updates from Bill and Dan, we'll open it up to Q&A. If you have a question, click on the Q&A icon at the bottom of your screen, type it, press submit. We'll try to address all of your questions at the end, but if we run out of time, we'll reach out to you directly and answer them one-on-one. Let's start with a brief update on fund performance. Our Miller Value Partners Appreciation ETF, symbol MVPA, was recently recategorized by Morningstar from the mid-cap value fund category to the small cap value fund category. So we'll mention relative performance versus both categories. Since the inception of MVPA, which was January 30th, 2024, so approximately 23 months ago or just under 2 years, through year-end 2025, MVPA returned 34.78%, outperforming both the small cap and mid-cap value categories, which returned 17.2% and 21.8% respectively. This robust outperformance since inception was achieved despite the fund's negative 2.92% return in calendar year 2025, a drawdown that we believe provided long-term investors an additional discount to an already undervalued portfolio. In fact, MVPA's portfolio trades at less than 10 times earnings versus greater than 25 times earnings for the S&P 500, and MVPA trades at less than 1 time sales versus the S&P 500 trading at 3.5 times sales. For Miller Income Fund, the iShare ticker is LMCLX. This fund seeks to find undervalued yield opportunities and can invest across the capital structure. At year-end, Miller Income's portfolio breakdown was approximately 80% in common stocks, 9% in bonds, 6% REITs, and 5% preferreds. With a 30-day SEC yield of approximately 6%, this fund provides the potential for both growth and income. Miller Income's 2025 calendar year return of 9.83% compared favorably to the benchmark, which is the Merrill Lynch High Yield Index. That returned 8.59% for the year. Zooming out further, Miller Income outperformed its benchmark for the 3-year, 5-year, 10-year, and since inception timeframes. For Miller Value Partners Leverage ETF, symbol MVPL, this ETF implements a proprietary algorithm including elements of volatility, market direction, leverage, and other variables to express either a bullish or very bullish market view. MVPL returned a positive 25.63% return for the calendar year 2025, compared to 17.88% for the S&P 500 index. MVPL's since inception return was 56.55% versus 38.12% for the S&P 500. Again, inception for MVPL was February 27th, 2024, or approximately 22 months ago. And for our Miller Deep Value Select strategy, we're restricted on what we can say here. Eligible investors need to be qualified clients. If you'd like to learn more, please contact us through millervalue.com or email me directly at dyazdan@millervalue.com. As you're about to hear, the past 2 years have created an environment where mispricings are widening, and we believe that favors skilled active managers, particularly in small and mid-cap universe. While bottom-up fundamentals remain central to us, macro forces such as fears of an AI bubble, shifting Fed policy, and extreme investor concentration in a handful of tech giants have distorted valuations across the rest of the market. Investor luminaries Ray Dalio and Howard Marks both note the combination of early-stage bubble dynamics in large-cap tech and attractive valuations elsewhere has created pockets of opportunity that passive indexes, which are dominated by megacaps, cannot exploit. Active managers, by contrast, can selectively target undervalued small cap and value names that remain overlooked despite improving fundamentals. The CFA Institute highlights that after 8 years of underperformance, small caps are poised for a cyclical turn driven by a myriad of structural catalysts, including falling rates, normalized inflation, earnings recovery, regulatory easing, and a more favorable tax environment, further amplifying the opportunity set for active strategies. Corporate actions are picking up as well. Mergers, privatizations, share buybacks, and other resource conversion events that tend to have an outsized impact on smaller companies, where price discovery is less efficient and passive ownership is lower. The result is a market rich with idiosyncratic, company specific catalysts. These are precisely the types of dynamics where active managers thrive and where passive index funds that are anchored to market cap weightings and index rebalancing rules are structurally unable to respond. With that, we encourage you to visit our website for year-end commentaries from both Dan and Bill. In Bill's letter titled "The World's Biggest Buyers Back and People Don't Get It," he argues that investors are missing the real story. The Federal Reserve has quietly executed a major policy shift, far more accommodative than headlines suggest. Expanding liquidity should support economic acceleration and higher equity prices, particularly in mid-cap value stock. So let's hand it over to Bill now to discuss this and more. Bill?
Thank you, everyone, for your time today. We very much appreciate it. David just did a fantabulous job with his introduction to my letter, which I'm going to lean heavily on for today's discussion. I think it's important. I encourage everyone to read it. It's at millervalue.com. And again, it's called "The World's Biggest Buyers Back and People Don't Get It." The overall message in the letter is pretty simple. What you read in the newspapers and what you hear from politicians is not indicative of what's going on at all among monetary policymakers. So in December, we just saw the biggest shift in Fed policy in at least 6 years. If you read the headline the next day in the Wall Street Journal, it says, "Fed cuts rates, signals a pause." Sounds like a very hawkish meeting at the margin. In reality, what they failed to mention in that article and what they published on a later page and on a much more mundane title is that quantitative tightening just ended. So what's been going on effectively for the past 3 to 4 years is the Fed's been talking out of both sides of their mouths. So they've been saying, "Oh, we're cutting rates, cutting rates, cutting rates." Yeah, that's great. But if you look at what they're actually doing, they're allowing their balance sheet to shrink. So we've seen the biggest shrinkage in liquidity over the past 3 to 4 years in the history of the United States Federal Reserve. And so the shift in December is incredibly significant because there's a handful of ways that the Fed can influence monetary policy, asset prices, and activity across the economy. One is through target interest rates. Two is through setting expectations and communicating to the market what they're planning on doing. And three is by actually injecting or changing liquidity balance that's available for economic activity. And so what happened was, while they were, again, cutting rates, they were removing liquidity. And so what just happened in December was they completely changed course on that. And instead of sucking $50 billion a month of liquidity out of the system, they are now providing $40 billion a month of liquidity into the system. And so people don't appreciate how important this is. They did it just in the nick of time, too. If you look at the most recent Trueflation readings, which have live up-to-date data around inflation, more relevant, I would say, than the government data, they're at 1.45% today, year over year. So they have plenty of room to do this, provide more liquidity, and get things going again. At the same time, the economy is still in pretty good shape, even though we're seeing some cracks in the labor market. Atlanta Fed now shows this quarter's GDP at 5.4%. And again, rates, the labor market is still expanding wages are expanding at 3.8%, which is meaningfully above that 1.4% I mentioned. So you're seeing real wage growth. You're seeing the Fed injecting liquidity into the market like they haven't done in years. And things are actually really good. All of this tends to favor what we own. And we're incredibly optimistic about where we're headed as an economy and where our portfolios are going. And so we're just beginning to see the effects of this liquidity. Liquidity injections are far more direct and operate with far less of a lag than interest rate targeting. And so, again, we're just at the very beginning here of an overall economic acceleration, strengthening labor market, and accelerating economy. And again, if you look at Bitcoin, it peaked kind of last year as liquidity stuff was tightening and bad things were happening behind the scenes. If you're following geekish interest rates and spreads that were blowing out, and things that the Fed was very worried about. Well, I think the bottom in Bitcoin's in, and we'll talk more about that later. But with that, I want to hand it back to Dan to go over to talk more about where the opportunities are in the market today.
Thanks, Bill. I appreciate the handover. We put together a couple of slides, similar to the past, that we want to walk through to actually highlight what we're seeing in the opportunity set. We'll wait for a second just for those to come up. And again, I think the underlying theme that David had highlighted to start is what we want to further kind of reiterate, the opportunity that we're seeing in the marketplace today. The first thing that we've noticed is we want to take a step back and look at where we're sitting today for 2025 at the end of the year, and thinking about where valuations are for the marketplace in general. And the first slide that we have that we're going to put up is highlights the S&P 500 index, and I'll just kind of walk you through a little bit of discussion of where we are today in the valuation. That's looking back over the last 30 years. And if you thought about where the market has traded over that time period, we're sitting today at the higher end. We ended the year at 22 times. The average over the last 30 years is 17 times. And if we think about where prior peaks have been over the last 30 years, 1999 and 2000 and 2021, were the only time periods in which you were higher than where we ended 2025. Also, if you think about from a CAPE or a cyclically adjusted PE multiple, which takes the current price divided by the average 10-year S&P 5 earnings, that actually ended looking at 2025 closer to 40 times. And you can see from this first chart on the left, we highlighted where the average of the thinking about where the P multiple is, which is that dotted line, that's 17 times. And you can see where we ended the year in the prior peaks going back to 2000 and 2021. Today, if we looked over the past 3 years, the S&P multiple has expanded from 15 times to 22 times. Current market environment would be the opposite of 2009, looking at that chart, where valuation multiples contracted to a 30-year low, and S&P 500 margins were at trough levels due to the Great Recession. It's a little bit smaller. The chart on the right actually plots the 5-year annualized forward returns of the S&P 500 relative to the forward PE multiple. And as the PE multiple increases, the 5-year annualized returns fall, the inverse relationship between the two. At current valuation levels, you can basically see that the historic 5-year annualized forward returns are expected to be slightly positive and below long-term inflation. Back in 2009, again, when you had S&P 500 forward PE multiple back at 11 times, historical forward 5-year annualized returns on that chart highlight that they'd be closer to high teens from a historical perspective. It's also kind of worth noting, just overall from the market, we're ending the year at near peak margins. If you went back over the last 25 years, consensus expectations are for 14% earnings growth in 2026 versus a long-term average of high single digits. So again, we're setting the backdrop here where the market in general, the S&P 500 is at the higher end of historical valuation. If we turn to the next slide, it'll highlight what's been driving the market concentration. And it's been a significant outperformance if you were to think of looking at the top 10 from a weighting perspective. We're sitting today at the end of the year, basically where the top 10 moved up to 41%, up from 26% at the end of 2022. So that's an all-time high. And in 2000, the top 10 peaked at 27%. In 2021, it peaked near 31%. The green line on that left chart highlights the top 10's contribution to earnings. And if you look at where that ended the year, that's 800 basis points below. And even though we're at peak levels of earnings versus where we were going back to 2021, the market weight and cap weight of the top 10 is 800 basis points higher. So it's a large spread versus history. The chart on the right looks at equal weighted returns versus market cap of the S&P 500 index by year. The average stock in the S&P 500 lagged the overall index over the past 3 years by more than 25%, as you can see from the red box. That's a rare occurrence. You'd have to go back to the other dotted box of 1997 to 1999. We had a similar magnitude of that 3-year time period. The late 90s was followed by 6 years of the equal weight outperforming as the market broadened out. The largest stocks underperformed as valuations contracted. In 2022, we saw the average stock in the S&P 500 outperform. That year, value and small caps also significantly outperformed longer duration and large cap market caps in general. On the next slide, we have 2 charts highlighting how valuations look very attractive today in small caps. The chart at the upper right highlights top 5 stocks versus the total Russell 2000 index. Top 5 stocks are more than 28% of the S&P 500. The dark line on that chart highlights the top 5 stocks are now more than 5 times the size of the entire Russell 2000. Prior to 2018, the ratio would fluctuate between 1 and 2 times. The red line highlights the price to sales. The last 25 years, it's typically been 1.5 to 2.5 times. However, today it's not far from the historical extremes, near 6 times. On the bottom chart, it looks at the next 12 months relative P multiple between small caps and large caps. Not surprising, small caps ended the year nearly 2 standard deviations below large caps. It's very similar to the 2000 time period. Small cap valuations are even more extreme if you were to look at other valuation multiples, whether it's price to cash flow, price to sales, or EV to EBITDA multiples. On the next slide, we highlight basically the rolling 10-year average relative returns between small caps and large caps. And we ended 2025 at the first decile when you go back over the past 100 years. Small caps have lagged large caps by approximately 6% annualized. And as you can see in the chart, the late 1990s, early 2000 was the last trough of similar nature. And going forward, small caps outperformed by 6% over the following 10 to 12 years. In addition, the chart on the bottom highlights how under-owned small caps are in the market in general. Small caps as a percentage of total equity is below the 2000 trough. It's nearly half those levels. One would have to go back to the 1930s to find a lower time period. And again, looking up at the top chart, coming out of the 1930s, small caps 10-year annual relative performance outperformed large caps by 5 to 10%, looking out 10 to 15 years from that time period. On the next slide, we highlight what we're seeing, which is growing positive drivers for a meaningful small cap outperformance cycle. We highlighted earlier on this call that if you go back and look, interest rates going back to the 1950s, there's been 14 interest rate easing cycles. We're currently in the midst of one. Large caps tend to lead early on. However, after about 150 basis points of cut, or around about 12 months from the start of the interest rate easing cycle, small caps have historically outperformed. 15 months after, if you go back and look at those 14 occurrences, small caps on average were up over 35% versus 21% for large caps. Earnings are also re-accelerating for small caps. We're emerging from a 2-year earnings recession for that portion of the market. During this past quarter or the third quarter, small cap earnings growth slightly exceeded large cap. It's the first time in more than 10 quarters, and consensus expectations are for that to continue 2026 and 2027. And relative valuations, as we walked through in the prior slide, are near historical extremes and remain very wide, favoring small caps. And then finally, deregulation, which continues across multiple industries, and also the $150 billion of stimulus from the upcoming tax cuts we think provides tailwinds for small cap profitability and earnings growth. On the next slide, we walk through and highlight fourth quarter returns. We don't think this is widely highlighted or picked up in the market, but you saw a broadening and a nice rotation within the equity market. Value outperformed growth by 270 to 724 basis points, and that was across all market caps, as you can see on the slide. And that broadening and rotation has continued. While it's still early in the year, only 3 weeks in, value is again leading, and small caps are now up in excess of 8% through the end of today. And that's more than 1,000 basis points ahead of large cap growth, which is actually negative, down close to 2% for the year. So we think we're still in the early innings of a small cap and value outperformance cycle. And if we go to the final slide, here I want to just highlight, one name in particular, Gray Media. The symbol is GTN. It's currently trading at around $4.46 a share. The company is a leading local television station owner. 90% of their 100+ stations are ranked number 1, number 2 in markets across the U.S. The market-leading share positions allows the company to disproportionately lead the industry for political revenue, in addition to organic growth. And then for this upcoming year, there's 28 of 35 Senate races, 30 of 38 governor races, and all of the House of Representatives seats are up for re-election in Gray's markets. Much larger number of races versus if you're compared to 2024. So the company appears to be well positioned, generate about 400 to 600 million plus of high margin political revenue there this year. That should help accelerate debt reduction. In addition, the industry has also started deregulation, which is underway with the FCC looking at rules that haven't been updated in excess of 25 years. Gray is waiting approval on small station acquisition swaps. And there's a potential to create, we think, 10 new market duopolies. If these close, they're at attractive valuation multiples, and it's nicely accretive to the balance sheet. The absolute valuation is near historical trough, less than 2 times 2026 earnings. The market cap is near this year's expected free cash flow. And as you can see on the chart, which is it's a deep discount to current book value of the share price. And with the accelerated debt reduction this year, no debt maturities before December 2028, we'd also believe that the 2031 debt looks significantly mispriced. It's trading in the mid-70s, and we believe that's an attractive opportunity within the capital structure. So with that, I'm going to turn the call back over to Bill.
All right. Thank you very much, Dan. I just wanted to review the portfolio positioning in both the income fund as well as the MBPA ETF, just so people can see how the portfolios fit into the overall thesis that we talked about earlier in the webinar. So if you look at the valuations in the income fund, which, as I think David touched upon earlier, has a roughly 6% 30-day SEC yield, they're compelling. So the price to free cash flow multiple in the income fund is 9.4 times. The price to free cash flow multiple in the S&P is 36 times. So you're getting a 74% discount to the S&P on price to free cash flow, which we think is one of the most meaningful metrics to look at on a shorthand basis if you want to think about future likely returns. The EV to EBITDA multiple on the income fund is 6.2 times versus 17.7 times on the S&P. That's a 65% discount. Again, very compelling. If you look at the multiple on the ETF, MBPA, it's a little higher than it has been in the past because we added some names. We'll talk about the investment theses for them later, like Mercado Libre, Figure Technology Group. Those are all new additions, so they're taking the multiple up a little bit. But the price to free cash flow multiple on MBPA is 12.4 times. Again, that's a 66% discount to the S&P. EV to EBITDA on MBPA, 10.7 times. That's a 40% discount to the market. So all of this, it speaks very highly or speaks very relevantly to what we talked about earlier. If you look at the market caps across our strategies. The overwhelming majority of what we own in both the income fund and MBPA are SMID caps. There are exceptions in there. There's Google, there's Mercado Libre, there's a few other things, but UPS. But overall, we're SMID cap value oriented strategy. I want to talk actually a little bit about thematics here in the portfolios. So most specifically MBPA, because a lot of times ETFs are sold on a thematic basis. So I can give you where 58% of the portfolio sits on a thematic basis. The biggest theme we have in the portfolio of MBPA is digital marketing. So that's 21% of the portfolio. If you look at it, it's Pinterest, Google, Quad, Ziff Davis, which is a content adjacent marketing business trading at a very, very low multiple. And we have Instacart. So that's 21% of the portfolio. Then we have a housing reacceleration bet. We talked about falling rates or increasing liquidity, all of which is very good for housing. That's 16%. Examples in the portfolio include Airbnb, Residio Technologies. If anyone has a smart home, it's probably on Control 4. That's Residio Technologies. Builders First Source, Master Brand Cabinets, and Geldwen Doors, Shark Ninja, and then we've got a small position, about 1.5% in Fannie and Freddie. So that would be the housing reacceleration bet. That's 16%. And then we have digital assets, which are 11%. We got a ton of questions on that. We'll talk more specifically about those names, but that's Figure Technology Group and MicroStrategy. And the final one would be dominant infrastructure plays. So that would be Mercado Libre, UPS. And so those are the main themes in the portfolio. That's 58% right there. And we think those are very good themes to be long right now. So I actually want to switch back now to David to jump into Q&A.
Thanks, Bill. Before we open it up to Q&A, if you missed it, Bill was on CNBC back on January 5th, where he discussed topics including our bull case for Bitcoin, as well as our thoughts on strategy, both the common and preferreds, and our investment in Figure Technology Solutions. You can watch the replay on CNBC's website. Also, Bill will be interviewed on Bloomberg's Masters in Business podcast on February 10th. The recording should be released shortly thereafter in mid-February. Dan and I will be meeting with clients and prospective investors in Richmond and Charlottesville, Virginia, February 3rd through the 5th. And I'll be in Birmingham and Tuscaloosa, March 5th through the 8th for the University of Alabama's Capstone Investor Conference. If you're in those areas, Richmond, Charlottesville, Birmingham, or Tuscaloosa, and would like to meet up, please reach out. So moving on to Q&A. Our first question goes to Dan. Dan, please update us on your thoughts on the Fossil Inc. and USA Today turnarounds.
Thanks, David. If you look at both those two names, both are transformation opportunity sets that we own. I talked earlier about 2009 and the market attractiveness being at trough margins and low valuations. That's essentially what the transformation opportunity sets that we're investing in. Fossil in particular has got a new CEO that came in, his historical track record for success undertaking transformations. He's focusing on exiting unprofitable stores and markets, launching new products that are coming out this year. And so while the exiting of those markets and stores are going to cause a near-term headwind for sales, we should be turning to growth and increasing profitability as we look at later this year into next year. And current share price, we believe, is incredibly attractive at less than 2.5 times normalized EBIT. And then on USA Today, it's formerly the Gannett. Company is also undergoing a multi-year transformation, which they're actually at the tail end of their transformation, similar to the successful one that was done by New York Times. Third largest audience reach in the U.S. And USA Today's digital revenues, which were 30% of revenue back going in 2019, is now in excess of 50% this year, and that's going to return the company to growth. And those digital revenue streams are high margins, accelerating free cash flow. And then the company is also looking at non-core asset sales, and a successful completion of their antitrust litigation could also accelerate debt reduction. And the shares we think remain incredibly attractive. 4 times enterprise value to EBITDA. If you look at New York Times today, it's trading at 20 times. So again, a massive discount. Not a lot of the transformation success is being priced in today.
All right. All right. Next question is for Bill and Dan. Do you remain fully invested throughout market cycles? What themes worry you in 2026, and what themes excite you about 2026?
Yeah, sure. So I'll start with that. I think if you think about investing from a first principles perspective, the reality is everyone's biggest cost is time. And so being in the market for a long period of time is much more likely to lead to the types of returns you're looking for than trying to time the market, which is effectively impossible. The market can go much higher than you think. It could get much more expensive than you think. And then not only do you have to call the peak, but then you have to call when to get back in. So it's very hard to call those times and inflection points around markets. Sometimes there are extremes where you can make a relatively safe bet, but it's very hard to do that over time, and you're going to miss a lot of returns if you try and time things. Things that worry me, someone else asked this question as well. I think just geopolitics and global strife seem to be escalating today. You look at defense stocks ripping, you look at some of the rhetoric going on, you look at what's going on over with China and potentially Taiwan. Those things worry me. But again, trying to make investment bets or time things around that is much more challenging than actually trying to find securities that are publicly traded with expectations that aren't likely to match what's going to happen for the next 3 to 5 years. So we just try and find stocks that have low embedded expectations and own those for the long term.
Yeah, I would, just to kind of throw on a couple comments on the back of that, I'd echo completely Bill's thoughts. Not being in the market being up 8% on average, for the last 100 years. If you miss the 10 best days, that average return falls to negative 13%. So it's a 21% difference from being, trying to time the market. And if you're not in the market, when the market goes up, those 10 best days. And just think about last year, April 9th, the market was up 9.5% that day. We just walked through slides. I'm incredibly, excited about what low valuation securities and small caps look like today. They're a big discount to private market transactions, the overall market. I think that's, bodes well for a nice return stream over the next couple of years.
Great. Now, next question's for Bill. Bill, what's your thesis on Mercado Libre, symbol MELI?
Yeah, so that is a new name. It's roughly 3% of MBPA today. I would not be surprised at all to see it moving higher to a bigger weight. It's the most dominant company in Latin America. So it has compounded top line at north of 30% CAGR for 27 consecutive quarters. All right, and it's growing more dominant. It has a flywheel effect going on where it has demand, retail demand and e-commerce. It has payments, and then it has fulfillment and logistics, and it then allows get all kinds of data, and now it's starting to crank out ads. So it's a dominant enterprise, basically the Amazon of Latin America. It's continuing to compound at a huge growth rate, but it's trading at the lowest valuation it's ever traded at. So this is just a basic inevitability of execution bet, I would say. So if you think it's going to continue to compound at a very high rate, which we do, just because e-commerce is massively underpenetrated in Latin America, and there's a ton of room for it to continue to grow. A 30% top line growth rate implies a double in just over 2 years. Do you think Mercado Libre is going to trade at a 16% free cash flow yield in 2 years? I don't. I think it should trade at much lower than 8% today. So again, we think this is just an inevitable bet on growth and a dominant company's continued dominance. And the expectations are very, very low at an 8% free cash flow yield. So we think there's a huge margin of safety in this one.
Another one for you, Bill, is on MVPL. What type of trend parameters do you use for managing MVPL?
Thanks for bringing that up. Actually, that was not a good performer last quarter. The reason being there were some unlucky, I would say, unlucky times around time of day on trades. We look at our signal once a day and make the execution at that time, and then it's the same systematic time of day. We make that decision every single day because you have to be systematic about the decision making. And so we've been lucky on the other side of it. We were unlucky this quarter. We think over the long term that should tend to even out. So just wanted to flag that. We don't use trend parameters. That's why it's a different strategy altogether relative to most trend following strategies. I don't want to get too much into what we do, but it's not a trend following strategy. There are no trend parameters whatsoever.
Okay, great. This is for both of you. Please share your views on market structure and the dominance of passive strategies, as well as your views on the long-term effects of that secular trend on the virtues of active management.
I'll start on this one. I'll start on this one, David, just because I was talking earlier. And quick thought. When we launched MBPA, we thought very carefully about cost, predominantly for this exact reason, in that it's just a basic math game, in that if you have a bunch of people, if you have an efficient, largely efficient market, and a huge portion of the people are paying zero fees effectively, they're effectively free riding on everyone else that is paying fees. And so you want to find a good manager at a low fee rate. When we launched MBPA, it was lower price than 4 out of 5 actively managed funds, and I would say probably lower priced from a style perspective. If you look at concentrated actively managed funds, then probably higher than 80%. So it's just a math thing where passive will continue to take share from active. There's still a compelling active and very competitive market out there. And so I think it's just going to continue. You're going to see a race to the bottom on fees, and it's going to be a continued challenge for people to justify them. And it's just going to be managers competing, and those who have the best IP and spend the most time focused on the market are going to do the best. So there are opportunities. I'm sure Dan has different perspectives on the opportunities presented by this skew.
Yeah, no, I think I almost think when you look at the two of those, they actually have very long cycles. Also, that I think maybe the market tends to disregard a little bit when you're seeing success for the past 5 to 10 years. And so I look at passive having significantly outperformed active, concentration going from 17 to 40%, valuation spreads nearing kind of wideness from kind of peak over that time period. The percentage of long duration assets in the market near an all-time high. So I think it's almost, in my opinion, history kind of tell you this is, when those things kind of line up, there's a pretty good opportunity for the market to broaden, active to do much better, low valuation do great. And usually that cycle goes, when you look back historically, it can go 6 to 12 years, not just be a year. So I don't want to say that passive's in a bubble, but I think there's already signs from all the things we highlighted that those 3 events are kind of coming together, and it sets up, if you're a stock picker, I think a pretty good environment.
Yeah, I think last year actually saw one of the strongest sets of returns in, I think it was 3 or 4 decades to momentum and trend following strategies.
Yeah.
And that kind of thing can reverse violently and quickly, especially when you see liquidity relative to the low expectations in small cap value versus the huge expectations in large growth. So,
All right, this one sort of piggybacks that in terms of just micro versus macro. And maybe Bill and Dan, both of you can chime in. Does one need to consider the mood of the world when investing? For example, does being pessimistic or optimistic about the future inform your investment views? Or does this fall under the macro and considered noise for bottom-up investors like Miller Value Partners?
I think it's always important to consider sentiments when it's at extremes, and it's easier to see the extremes. But overall, again, we're long-term investors. We're in the market all the time. It's a long-term game. In the long run, it's a weighing machine. So we're trying to find mispricings today and own them for the long run. So we don't consider the mood all that much.
Yeah, I completely echo that too. And I think volatility going up gives us opportunities. So we think risk is permanent capital loss. It's not, volatility and how the market kind of perceives different things. And when expectations are low, that's the opportunity set we're trying to capture for clients.
Okay. And this one's for Bill. It's a culmination of a bunch of different questions in the crypto Bitcoin space. Um, what are your thoughts on Bitcoin, Ethereum, stablecoin, other altcoins? Um, and then your thoughts on Bitcoin immersion technology, symbol BMNR. Thoughts on Bitcoin treasury companies, valuations in general, thoughts on whether the 4 year cycle for Bitcoin is still intact, and do we see any threat to Bitcoin from quantum computing?
So Bitcoin, people are freaking out because gold's going up this year. I saw a talking head the other day on CNBC say, well, I guess Bitcoin's just another risk asset because gold's going up and Bitcoin's not. Maybe Bitcoin's over. I don't know how many times we've heard that over the past decade, but it's hilarious at this point. So in 2023, Bitcoin was up 165%, and 2024 is up 124%. Last year, it's down 5%, and now all of a sudden, Bitcoin's done. I mean, come on. The one of the big opportunities out there is to think quantitatively when other people are not. And so if you actually just look at what's Bitcoin's correlation with gold over the past decade, 0.09. It's not correlated with gold. So just because gold's going up doesn't mean you think Bitcoin should go up and it's broken. Its market cap is like 1/15 of gold's, maybe even less at this point today. And so it's still massively underowned globally. And you asked earlier, David, about quantum's threat to it. Am I worried about quantum? No, I'm not worried about quantum. So the most optimistic estimates around when quantum could potentially have an impact on Bitcoin are at least 8 years out. And I think it's important to contextualize when you buy any crypto, you are buying a governance system around that capital. Bitcoin's governance is a living, breathing thing, right? So last year, there were 285,000 lines of code added by 135 unique contributors to Bitcoin. I think we can figure it out in 8 years exactly what we should do. You don't want to come up with a solution too early because there could be technological developments down the road that are better and potentially more lasting. No. So is quantum a real threat? Sure, it's a real threat to the original protocol, but there's all kinds of solutions around it. It's a bigger threat to fiat systems, whether we're talking about property rights databases, tax ledgers, local governments, banks. And so that needs to be solved as well. And can Bitcoin figure it out? I think absolutely. That's the whole point of the governance system around it and why it's actually decentralized relative to all the others proof of stake things out there. So not worried about quantum. Very optimistic about Bitcoin, given what we talked about liquidity and the positioning there. Digital assets broadly is a theme I am excited about this year. We talked about we talked about on CNBC Figure Technology Group. I'm going to touch on that one again here today because it's the largest position in MBPA. Everyone knows me more as a Bitcoin maxi, quote unquote, but you got to be realistic sometimes. And you got to understand that your views have to change when reality changes. I still think Bitcoin is the most dominant blockchain technology and will continue to be so for the indefinite future. Reality is other financial institutions are adopting different blockchain technologies, and the leader in providing that right now is Figure Technology Group. Why is this such an interesting idea? Number one, it's profitable, even though it's incredibly small and growing very, very fast. But it's total addressable market from a revenue perspective, $185 billion a year. This thing has margins north of 50%. Okay. Its market cap is $15 billion. Let's say it continues to have a 70% market share. It would capture $130 billion in revenue at a 50 or 60% margin. That's, $60 billion in annual profits, and the thing's market cap is $15 billion today. So we absolutely love this from a long-term growth perspective. And that's why it's our biggest position. So we're excited about digital assets. We're excited about Bitcoin. No, we're not worried about quantum. The other question I know we had come in, I'm just going to hit it since I'm all hitting digital assets here all at the same time, is what else can Saylor do to monetize his Bitcoin or make money off of it? And the answer is it doesn't really matter to me at this point. All he should just do is hold Bitcoin. He has decent leverage on the Bitcoin. It trades effectively near NAV. And if you're bullish on Bitcoin, you need to be bullish on MicroStrategy because it's going to get that leverage boost to it. And you're also going to get potential multiple accretion from 1.07 times NAV today to potentially the multiples it traded at before as people get excited about it and he's able to put the capital to work creatively and sell shares into the market if that keeps going up. So I don't really think he needs to do anything except what he has been doing and just let Bitcoin eat. So optimistic on that one as well.
That's great. Question came in, if you are fully invested all the time, what changes can you make to a portfolio like MVPA in a severe downturn to capitalize on even better opportunities that may show up?
I think you need to be cognizant of where valuations are shifting relative to actual economics through the downturn. And you can just, one of the great things about the way we can trade that is we can make changes through in-kind transactions. So we don't have to pay taxes on the sales. And you can then, again, if you're opportunistic around where the biggest mispricings are through a downturn, you can do it on a tax advantage basis or a tax-free basis. And so that would be the short answer to that. But I did want to remind everyone of one thing. You know, people are freaking out. I don't know if you bought Bitcoin at the peak or whatever. Keep in mind, at current legislation, there are no tax wash rules on Bitcoin. So if you're down on a big chunk of your Bitcoin, sell it, take a deep breath, and buy it back immediately the next second. Use that tax loss carry forward to offset something else in your portfolio, and we're just bank it for a later day. So that's important for people to realize is be opportunistic on the tax advantages under the current legislation.
Well, we have to cover the AI bubble. Here's a question. Is there an AI bubble? How to avoid companies that might not come out strong if there is an AI bubble? And then another question on NVIDIA's gross margins and the 5-year growth rate. Does that tell a story?
Yeah, so you can buy our funds because we don't own a lot of a lot of the high-priced AI stuff. That's a good way to avoid it. But I'm going to reference my shareholder letter actually from Q3 of last year because I actually flagged a really important stat that I think people need to be aware of, which is so there was a study by Bain that looked at all of the investment going into AI. And what they basically found from an ROIC perspective was that AI companies would need to reach marginal revenues generated by AI would need to reach 2 trillion a year by 2030. Okay, to put that into context, that's more than the combined annual revenue of Microsoft, Alphabet, Meta, Nvidia, Apple, and Amazon. These companies have been growing for 30, 40, 50 years in a dominant fashion. Okay, and you need to come up in the next 4 to 5 years with that level of revenue combined to justify all the revenue, all the investment going into this. And just to put that into perspective also, that's more than 5 times the size of the entire global subscription software market today. All right, so there's a high hurdle rate here. Will there be winners? Sure. You know, if you ask me about NVIDIA, it's kind of like asking Jamie Dimon about Bitcoin because he missed it. I don't know why you'd ask him for his marginal perspective. It's like asking me about NVIDIA. But, you know, I'll just tell you what's on Bloomberg, 70% gross margins and roughly in 5 years for them. So, you know, still growing well. So, you know, is NVIDIA necessarily in a bubble? No. But do we like at the margin things that are much lower valued given the economic acceleration we see happening? Yes.
Yeah, I'll also highlight just a study we were looking at and highlighted also in the quarterly letter. There's if you look at the 12 largest AI linked stocks since ChatGPT came out in 2022, they've added 15 trillion in market cap. During that same time period, their revenue went up 650 billion. So you had more than 20 times increase in market cap to incremental revenue. So, you know, again, expectations I think are pretty high, and it's forward growth that's already being discounted. Those same companies, 12 companies, are more than 30% weighted in the S&P 500, and they're nearly 50% of the Russell 1000 growth. So to echo kind of what Bill had mentioned previously, We think passive and growth-oriented indexes are priced with pretty high expectations. Great time to diversify, great time to consider value-oriented, concentrated strategies. We think we have a bunch of those that look pretty interesting.
Next question is a little more granular for you, Bill. Can you talk about the strategy preferred, symbol STRC? Digital credit market seems to be in its infancy.
Yeah, we actually don't own that, but it's been a huge success for them. Part of the idea there is they toggle the dividend to keep the thing close to par. I think it's senior in their capital structure. Um, we own STRD in the income fund and just straight up MSTR because we're willing to trade off on that volatility versus the long-term return. And so those are the ways you do it. If you care immensely about that, having stability of principal and a high current yield, you value stretch more. So, and you buy that. But I do think it's in its infancy. It's a really creative product. The entire capital structure of MSTR is incredibly creative and thoughtful. I actually think it's interesting. I mentioned this on CNBC as well. It's the safest it's ever been with him sitting on almost 3 years effectively of dividends in USD cash. And it trades at the lowest multiple we've seen in a long time. So that's a nice setup, I think, for MSTR, especially when we think Bitcoin's going up.
I think we have time for one more question. This one's for Dan. Any positions you have highlighted over the last few years which you have exited or no longer see good potential? And is there any potential for you opening a mutual fund?
And so we don't, unfortunately, given the fact that as David kind of did the intro, we really can't comment on individual kind of position sizes, names we opened. One thing I will highlight is if you went back and looked at Deep Value's historical performance, 80% of what we've generated historical performance, we no longer own. And so we've recycled that capital into new names or increased weightings in ones that have underperformed the strategy. And so if the price has gone down and we still are convinced the opportunity set's there, expect us to actually own more of those names in the portfolio. And today, it's just being offered as a separate managed account for accredited investors. If there's interest, feel free to reach out to David or myself.
Great. Thank you, guys. Now, before we close, please help us by completing this 2-question survey to assist in our efforts to improve the MVP client experience. Your feedback is helpful and appreciated. We conclude today's Miller Value Partners live update. Thank you for joining us. Remember, you can follow us on X and LinkedIn and our website, millervalue.com. So we encourage your questions and suggestions and other feedback and look forward to updating you again in April.